So much, Judy, and thank you to Gary and Nikki and to Robin and to all of you for coming tonight. I hope it's going to be a really helpful evening for everybody. We have a lot of material to cover, so I am going to be literally just diving in. And I'm going to start with Gary. It's a panel discussion. We'll be answering questions as we go along in the chat. But welcome, Gary. And I'm going to ask the most obvious question. What does it mean for someone to be hiring a forensic accountant as it relates to divorce? Talk to me about that.
Sure. Well, essentially, forensic accounting is the area where you look for evidential matter to support a case or a matter that you're involved in. So what we do is we look at the information that we're provided from both the client and the counsel. And this might also be a good point to talk about the engagement. Typically, we're engaged by counsel under an agreement called a Covel letter. And the reason that and it's Kovel letter. And the reason that we're engaged under that agreement, the attorney becomes our client. The party becomes responsible for the fees. But what that does, it creates an attorney-client privilege between my firm as well as the attorney that we're working with. This way, anything that we discuss, anything that we find, anything that we calculate becomes privileged, and it's up to counsel and our decision along with the client whether or not we should be using that in the matter. But essentially, forensic accounting is the area that you take all of this evidential matter, analyze it and evaluate it, and get it ready for trial.
So, Gary, first of all, I want to thank you for bringing up the Covel agreement. And just so everybody understands, the most important thing that you all have, if you're working with an attorney, is your attorney-client privilege, right? It is what you say to your attorney and what your attorney says to you, and when you communicate, et cetera, via email, via text, all of that. That is a solid privilege. And you do not want to waive that privilege because nobody really knows what you and your attorney are communicating about. That's why you can strategize with your attorney. But when you bring in a forensic accountant and you do it yourself, it's not privileged. So first of all, you should know your CPA, your accountant, your therapist, all those people, they're not really all privileged, believe it or not. And we can get into that another night. But in certain areas, all those people could be subpoenaed, all those people can testify, all those people may have to give information. So that's why it's really important, as Gary said, that you actually have your attorney hire your forensic accountant. They actually then communicate, and when they communicate, there is a privilege because the attorney, right, becomes the client, correct, Gary?
Absolutely.
And you pay, correct, or your spouse, depending, right? But your attorney is the client, and that privilege extends between your attorney then and somebody like Gary or Gary himself.
And
So,
while we're talking about forensic accountants and attorneys, I'm going to strongly urge you to make sure you get the proper ones. For example, you don't want to go to a podiatrist for heart transplant. So you want to be schooled, have an attorney that's schooled in the matrimonial field, and you want to have a CPA or a CFE. I have a number of credentials after my name, as you could see. Each one of these is a different specialty that I use when I'm on the witness stand and making my presentation to the trier of facts.
so Gary, sometimes people decide together to hire a forensic accountant as what's called a neutral, meaning one forensic accountant for both people.
Or they're appointed by the court.
Or they're appointed by the court, right, as a neutral, okay? Or the court could allow people to get their own forensic accountant. So what is the difference between that? And tell us why, or if it's advantageous for you to have your own forensic accountant as opposed to a neutral.
Sure. So I'll start with the neutral because I think that's easier. The neutral is where, as Lisa just mentioned, both parties engage you equally under one engagement letter. And even if there's attorneys involved, they'll typically have both parties sign as well as the attorneys that are involved. But being a neutral on a matter, it's fully transparent, full disclosure. I can't have what's called any ex parte discussions with one side So if I find something out, for example, and I'm just making this up, but if I find out that there's a $10 million offshore bank account that one of the spouses has, the other spouse is going to know about that $10 million offshore bank account. If I come up with a value for a business, that value of that business is going to be shared with both parties concurrently at the same time. Everything we do, all the emails, all the correspondence, all the phone calls are fully transparent. Everybody's aware of everything. When you're hired as an expert by one side, as we just discussed a moment ago, under that Covell agreement, there's an attorney-client privilege, and with that comes the ability to strategize, to plan, to make a determination whether what you want to share, when you want to share it, and also what information that you have and how you use it going through the process. Because those of you that have heard me speak before, I always say knowledge is power, and the more knowledge you have, the more powerful you are. But I'll take it one step further and say how you use that knowledge is even more powerful as you go through the process.
Gary, I'm going to say, when I work with a forensic accountant, they're my partner. Okay.
Thank you.
We're working, I'm serious. Okay. They're my partner. I know that I can pick up the
Yeah.
phone, and that's the part that I like, and not about having someone having their own forensic accountant. I can pick up the phone and I can call Gary, or I can call one of the people that works for Gary, and I can have a conversation and I can say, what do you think about this? Or do you think we should be looking at that? Or maybe we should change our strategy and do this. And that is a privilege that I have because my client has hired Gary as the forensic accountant. But when Gary is appointed as a neutral, I can't do that anymore, right, Gary?
Right, right. Because I can't, first of all, I can't have the ex parte discussions, number one. And number two, they don't have to be mind readers to understand what you're thinking because it's going to be discussed in the open. It's like playing blackjack with open hands.
It's exactly right. And you keep using the word ex parte. And to Robin's point, there's a bunch of terms that and that people hear that we all use, okay, that many people don't have any idea what they mean because they're our terminology, right?
Right. We
We
live and
use them
breathe
every
it.
day. So what does ex parte mean?
Oh, ex parte is basically a discussion with one party without the other party being present.
Right. Okay. So, in other words, ex parte meaning if you're neutral, I can't have my discussion without the other attorney from the other side being on the phone. If you're my accountant, I can have discussions with you all day long and emails and all of those things. And that is not subject to anybody's ears at that point. So, nobody knows the direction that we're going in. So, Gary, there's a few things that I know certainly our firm has retained you to do, and I'm going to talk about the three different areas that I think we actually utilize your firm services the most. And if you can
Sure.
explain what each of these areas are. So, the first one is going to be income stream analysis.
Mm-hmm.
The second one is separate property tracing.
Mm-hmm.
And the third one is valuation of business. Can you
Sure.
explain what each of those three terms are? And then I'm going to take you through the next step of this exercise, but let's explain to everybody what those are.
Sure. So the first one is essentially the income stream analysis, which is essentially almost like a lifestyle analysis. What you want to do is you want to understand well, let me take a step back because they're really mutually exclusive. Somebody's income is not always indicative of their lifestyle. So what I've got to do is I've got to pause here for a second because somebody could be living a lifestyle and it might not be indicative of the income that they're showing. I was involved in a case one time where they lived uh, lavish vacations, three homes, kids' college paid for, and the gentleman made $50,000 a year. Obviously, it wasn't sufficient to support the lifestyle that they had. So what we do oftentimes is we do what's known as a lifestyle analysis, which will talk about the lifestyle that a person has been accustomed to 5 years prior to the date of commencement. And then what we also do is we'll look at the income stream to see if that income stream will support the lifestyle that those people are living. If it does not, that means there's either hidden assets or there's income coming in from sources that are not reported to, and I'll say the word IRS, or other taxing authorities. So that's probably the start or foundation of the first thing that we do for your firm. Lisa, the second separate property analysis is where we calculate and determine what property is separate property prior to the marriage and how that property is currently held. Because something that might have been a separate property, I'm raising my hand here because my hands are being shown. I don't know if you could see that, but my hand is up. But separate property is a determination of whether or not of what the assets, who owns the assets, etc. The third one that you mentioned is often um, times the could become the most valuable in the marital estate, depending upon the business that the person owns. And that's typically a valuation. And valuations are typically done by individuals like myself or someone who has similar or other credentials. There are a number of credentials out there. I have the CVA, there's an ABV, there's an ASA, there's other credentials out there. I've seen PhDs that have done valuations as well. So there's various criteria or credentials that are available. But essentially, a valuation is where you determine what the value of a spouse's business is as of the date of commencement. And I'm going to raise a couple things. Number one, it's what's known and knowable at the date in which you do the valuation. Number one. Number two, when you do a valuation for a business, and let's take something like a restaurant. A restaurant, you could do it, you have to do it or look at it three different ways. You have to consider it three different ways. That doesn't mean you have to value it in your ultimate opinion, because at the end of the day, your valuation is going to say, in my opinion, based upon a reasonable degree of professional certainty, the value of this business is X or Z. So you have to look at it from an income approach, which I'm going to come back to because it's a little more in depth. You have to look at it a market approach, comparing that business to other businesses, either privately held or publicly held. And you have to look at it from the asset approach. And the asset approach is basically looking at it at the value of the assets in the business. I was involved in valuing a funeral home several years ago, 4 funeral homes. The value of the funeral homes was close to zero because he was just doing a terrible job running it. But each one of those funeral homes was housed in a separate residence that the homes were each worth $1.5 million. So the value of those funeral homes came to be $6 million, even though they weren't generating any cash flows, because we looked at it a different way. So you got as I said, the income, the market, comparing it to others, and the asset. The income approach is divided into 2 different areas. What you can do with the income approach, and essentially, is you want to look at how much income this business is generating. And you typically look at it over a 5-year period. And then what you do is you capitalize or you multiply that average income that you have after a 5-year period times I'm going to, without getting technical, called a cap rate. Let's call it 25%. So you would multiply it by 4 or divide it by 25% and come up with your cap rate of the business. The second way of doing it is to discount the future cash flows. So if your business was operating for 5 years, and let's say something like COVID happened, it was a restaurant, and it wasn't going to operate anymore in the same manner that it operated in the past, you have the client do what's known as projections, and then you discount the future cash flows of the business back to the dollars at the date of commencement. So one is looking at historical earnings, capitalizing it. One's looking at future earnings, discounting it. And there's only one other thing I'm going to mention as we go through this process. I know I gave you a lot of information in a short amount of time, but one of the things that we look at when we go through these valuations, and I think is very important and would play into the income stream and lifestyle, is something called normalization. If you have an individual that's paying a lot of expenses through their business, so for example, they're paying their mortgage, their health insurance, their car insurance, I've seen where kids' college tuition is paid through the business. All those items that are not business related items get added back. If the individual is taking a minimal salary because they don't need a large salary, because why? They're paying all these expenses through the business, so they need less money to live on. We would then normalize the salary. So instead of making $35,000 a year, they're really making $300,000 a year. Because had they not taken these items out of the business and gotten the tax deduction on the business side, they would have taken it as salary and been taxed individually. So you can't have it both ways. So that's called normalization.
So Gary, you've said a lot in terms
I
of
know, I
your
have.
different approaches, and it is complex. It's complex, by the way, for everybody who's out there, even for the lawyers,
And
okay?
the
Which,
judges.
and the judges, which is why it's always good to be able to have those discussions with your accounting firm, okay, so that you could actually understand it. And when I say you, so that your lawyer can understand what approaches are being taken. I want to go back to the income stream analysis for a minute,
Sure.
because many of you, if you're going through a divorce or thinking about a divorce, the income stream analysis is really important to establishing what your lifestyle is. And that may be helpful in areas such as child support and alimony, actually, correct, Gary?
Yes.
And so what documents, because I get asked this all the time, okay? What documents should people start to collect, or if they're in the middle of the divorce, should they be looking for to be able to give to their attorney so that the accounting firm could figure out a lifestyle analysis or evaluation, or to find separate property. And there are three very different things. So let's start with the
Sure.
income stream analysis. In order for somebody to figure out what is the lifestyle, essentially, right? What documents do they need to give to you?
Bank statements, mortgage statements, tax returns, brokerage accounts, any type of contracts they might have for um, any of their vendors that are providing services in their home or their residence, utility bills, credit card statements. That's key because credit card statements, we might see a lump sum $7,000, $15,000, $5,000, $3,000. We have to know what makes up that total on the credit card statements. So we take a deeper dive. Tuition for children if they're in private school, synagogues or churches, anything that you really goes out of your bank account, you've got to be aware of.
Okay, so that's for the lifestyle analysis. And then, and we can talk about later how that is helpful in terms of putting together even your statement of net worth, frankly.
Which is the
Or
foundation of what your divorce is really built on. That is the bedrock.
correct. And why it's also important if you're doing a motion for pendente lite relief. If somebody hasn't heard of that, that would mean interim support, interim legal fees, interim expert fees. Gary's an expert, he's got to get paid somehow. So some of you may be at some point applying to the court to have Gary paid so that your spouse could help pay, okay? These are all, this lifestyle analysis is very helpful to the court to learn what is the lifestyle, because your spouse may be saying, well, the lifestyle is not that great, okay? The
Right.
lifestyle may be like very low on his net worth statement, okay, or her net worth statement, depending upon your spouse. But bottom line is that if the lifestyle is correctly seen by the judge, then there may be more of an opportunity for more alimony, for more child support, frankly, for more legal fees, for more expert fees. These are all important to get you set up in terms of your case. If your case is set up correctly, if it's crafted correctly with a lifestyle analysis, it's very helpful. It's not inexpensive to do, but it may be worth it. Let's talk about separate property. And I'm going to go back to something you said, Gary. You said separate property is from premarital assets, but it also could be from other things that happen during the marriage, such as inheritances that you receive during the
Correct.
marriage, okay?
Correct.
or gifts that have been received during the marriage, perhaps from parents, in-laws, your an aunt,
Trusts.
right? Trusts, income, exactly. So, Gary, talk about what documents do people need to gather to prove their separate property?
Again, if there's a trust agreement in place that you have, that would be one of the first things. Second thing is I would like to see any type of brokerage accounts or bank statements that predated the date of marriage. Um, things like that. Anything that you could fix at a particular point in time prior to the date of the marriage is probably the best foundation. We talked earlier that a forensic accountant gathers evidential matter to support their conclusions for the trier of fact. So these are the kind of things that I would look at to support my conclusions.
Okay, and let's keep in mind, everybody, that to get your separate property in a divorce, whose burden is it, Gary? To
Yours,
prove it's yours.
yours.
Okay, so if you want to prove your separate property, you need to actually make sure that you get all your documents together. That is your highest burden, okay? It is because that's going to be money that's just going to come to you. You're not going to have to share it if you've proven that it's your separate property. It's incredibly important, okay? Some of you may have prenups or postnups. Perhaps those already detail the issues, okay? Perhaps they don't detail them as well as they should, but proving your separate property is your burden under the law in New York State. Now, keep in mind, other states may differ, and we are
Right.
talking largely about New York State tonight. But Gary, does it differ in other states? Because you work in other states.
hmm Yeah. Oh, yeah. Yeah. Each state. I was just on the phone call today with the client in Puerto Rico, and I started telling the current client mentioned one thing to the attorney. Said, "Not down here, not down here." That's exactly what she kept on saying. So you really have to have an attorney and forensic accountant that's familiar with the state laws, because it's so important. And even in valuations, there's discounts and controls and other things that come into play, and there's different case law in various states depending upon what the court has ruled in the past.
And Gary, you talked about state law, but I'm just going to say there's also local rules. Okay, so depending upon, and I'll say even further, there's judges' rules.
There are
So
judges' rules.
you need, right? Each judge has their own rules.
Yeah.
Okay, and they have what their court is their court rules. And so you must make sure that your attorney is familiar with that judge's court rules. They're published, by the way. It's not like a big secret. Okay,
Right.
but I have seen so many times that attorneys are not familiar with the judge's rules, and that is a disaster because they don't understand. Maybe there's page limits on things or due dates for things or any of those things, and that is really super, super important.
And that's why
So,
it's also important to have local counsel, because
yes.
they also know the judges and the judges know them.
Yes, and the judges will also know who's honest and who's not, and that is an incredibly important thing for you. So Gary, there is something in the chat, a question in the chat, and I do want to go to it. Okay, so the question is, so clarification. A
hmm
forensic accountant can discover hidden accounts slash properties offshore as well as in other states besides where the primary residence is. What's the answer to that question briefly?
Sometimes, sometimes it
Right.
can't.
Right. Okay. It depends, right? It depends. And we don't have that like magic ball here, that magic crystal ball. It depends on what documentation there is. And
And how
here's
it's
the thing.
structured as well. Because I see the second part, Lisa, not to steal your thunder, but
No, that's good.
you have corporations and LLCs that might be set up in third party names that you have to do searches. I'd been involved in a forensic case. It wasn't a matrimonial one time. However, what I did is I did a Google search of the individuals, and I got a hit out in California. And that individual set up a separate entity in California where he was siphoning off assets of the company and shipping them off to a separate warehouse, unbeknownst to and this was involving a lender. So the lender's collateral, which was inventory, was going to a third party warehouse to sit, that was not allowed to be counted as the collateral, so that if anything happened with that business, this gentleman could go out and start a new business using that inventory that was siphoned off.
So I'm going to move to Nikki for a few minutes. Actually, Nikki. So how do people how do you plan pre and during the divorce for post divorce, essentially, Nikki?
Yeah, absolutely. I want to thank Gary for summarizing an 8-week class briefly. I will say I'm always staying within the scope. So whether I'm teaching intro to finance, business management, or continuing education for financial professionals, we start with the statement of net worth. And for divorce, it's a little bit different than what it's going to look like, to Robin's earlier point on what you're familiar with from a business approach. Because when we're looking at that net worth statement for preparation and divorce proceedings, they want to unearth every rock. You've got a blockbuster fee from 2015. They want to know about that. And when you're itemizing your credit card statements, to Gary's earlier point, you got to know, is that cost for clothing? Is that for the kids or is that for me? Additionally, Amazon may be our best friend in general when we can get things next day, but when you see it on your credit card statement, you're going to cringe. I'm sure Robin will share a little bit about that as well. But what I often find with my clients, particularly working with families who are impacted by special needs, is that I'm in the room with someone on the worst day after they've just had the worst day. They've just been told, they've just decided that they're going to get a divorce, and you got to comb through everything, unearth every rock, and go through every single asset. To Gary's earlier point, we want the bank statements, we want the tax returns, we want the W-2s. We want to be able to see everything so that you can get what you need. And that statement of net worth covers it all: assets, liabilities, income, expenses, and sustainability as well for your lifestyle.
Robin, I know that you actually are familiar with the net worth statement. So can you give some tips? First of all, maybe you could share how you felt about filling out the net worth statement yourself, and then give some tips about how to deal with it. Because
Sure.
it's
So
quite the
to
thing.
take off a little bit about what Judy said in the intro, I've worked in finance and banking for 20 years. I was the one in our marriage that did all the finances and paid the bills and the credit card statements and set up the mortgages and the car leases. Like, I knew all the information. I was that person. And when I walked into my attorney, Lisa's office at the beginning of our process, I said, I'll be able to do this, no problem. And she said, okay, great. Just start working on it and I'll take it anytime you want. And I was like, yeah, all good. And then about a month or two later, she really needed the net worth statement and started asking me about it. And I was like, yeah, that thing. I have no idea. What are you talking about? Net worth? Anyways, it was almost impossible in that point in time where I was in my divorce process with all of the stress and the pieces that were moving around me to sit down and focus and put together this net worth statement. So I guess my best advice is get ahead of this thing. If you are not happy in your marriage and you are thinking that either you or your spouse might be looking to start a divorce proceeding, go online. If you're in New York, you just Google statement of net worth. You can print it out and you can look at it. It doesn't look so scary when you're not in the middle of a divorce. I also just posted a little thing in the chat that said a lot of the information that you're going to need for this statement, you're going to need for your regular taxes that are due April 15th. So as you're pulling together your W-2s and your pay stubs, or your bank statements and your 1099s and your brokerage account statements and all of those things, just save them down, but grab a few more too and start getting the pieces that you might need for something that you're already doing to start putting the information into that document. And then last but not least, there are people to help you with this. There's Savvy Ladies, there's CDFAs, there's financial professionals. So don't wait and let this thing just ride on your shoulders and be this huge bugaboo. Let's start it early. Ask for help. If you know how to use Excel and whatnot, do it. If you don't, find out and try to just do one little bit at a time, and it won't be so scary. If you try to tackle the whole thing over a weekend, as Nikki said, you're going to get stuck in the Amazon trap, because unlike your Amex statement or your credit card statement that's going to break out every single line, and sometimes they even categorize it nicely for you, it just says Amazon. You have no idea if that was for dog food or for toilet paper or for, anything for your kids, for yourself. And if you do like 5 purchases at once, you can't break it out. It's a nightmare. So think about that as you're using Amazon, because it's going to be really hard to unwind that a little bit later. So get some help if you need help. And then the last thing that I will say on this is, you really, in this whole process, you are going to get to know your finances so much better than you did while you were in your marriage. And when you walk out of it, you are going to have full control over your finances. Now, they might be smaller than they were before. In fact, they most certainly will be smaller than they were before, I would say 100%, but Lisa, correct me if I'm wrong. But you will be in control. And that is a huge opportunity to really take stock of what do you want, what do you need, what's essential, what can you pare back on, and really cut your cloth accordingly going into this next phase of your life. And these probably are not going to be your divorce year and the one right after or so. They're not going to be your strongest financial years. You're not going to be able to probably take that amazing trip you wanted to take or that big purchase. You're just going to have to take a step back and buckle down. But if you do the right things, if you do make financially smart decisions, if you set up your investments in the right way and save and grow your money and have your money work for you and employ yourself appropriately and earn money, you'll have a strong financial future that you are in control of.
That was really helpful, Robin. And I think that the idea of taking control is what Savvy Ladies is all about. And so I think that's so important, actually. And I'm going to talk about this actually with you for a second, Nikki, because part of taking control is partly actually deciding what to do with the marital residence. And I think it's really important. People ask me this all the time. What do I do about the family home? Should I keep it? Should I let it go? What are the considerations that you discuss with your clients about the family home?
And to Robin's earlier point, we can't ignore how much decision fatigue is already going on for folks who are looking to get divorced. So when you're thinking about that decision, there's a lot of emotions attached to it. Was that the family home that you all owned for the last 30 years of your marriage? Did you buy it a year ago? There are considerations from the tax perspective of the capital gains. Do you have a significant amount of gains that you're going to have to pay taxes on? Or is this mitigated by the exclusion benefit that we all get for selling our primary residences? Additionally, if any of the parties want to continue to live in the family or in the family home with young children, those are considerations as well. So it's all of the elements combined, both emotional, psychological, financial, and the perspective of who wants that property as well. I don't want to ignore the fact of if there was infidelity in that home, right? We want to make sure that we're being respectful of everyone we're talking to. Because when I sit in the room with folks, I love to tell them that we all flatter ourselves that we're thinking creatures who occasionally feel, but in reality, we're feeling creatures who occasionally think. Let's acknowledge that and make our priorities and our goals accordingly.
So I'm going to say a couple of things. First of all, you talked about the exclusion, okay? And everybody might not know what that means, okay?
Sure.
So what is the exclusion that you're talking about, Nikki? And how does it apply if you sell the family home as a married couple or you sell it when you're actually already divorced? Talk to me
Yeah.
about that.
Great question. So if you're buying a home for $1 million and you sell that home for 1.5 million and you're married, you pay nothing in taxes. That's the $500,000 of exclusion for married filing jointly. You have that if you're filing singly. So If you have that same $1 million home and you sell it for 1.5, you only get $250,000 excluded from your taxes if you're an individual. So prior to finalizing or completing your divorce proceedings, it could make sense to sell the primary residence or the family home.
Talk to me, Robin, about the concept of the family home and what your how you experienced that in some
Yeah.
ways.
Yeah. So we had lived in our family home for probably almost 10 years prior to our separation. And the house had a lot of equity built up in it. It had appreciated greatly, and we didn't have a lot of debt on it. And when it came time to really think about what is going to be best for each, spouse or ex-spouse overall and the children, we decided that the children, we were going to retain the house for one of us, but we decided that my ex-husband would keep the house and that I would move to a new house. And that did a couple of things. For me, it preserved liquidity, which was important to me, because there was a lot of equity in the house. I would have had to have used a lot of my available finances and liquidity to own the house. And, it was in a high tax jurisdiction. It's a large home. The upkeep was high. And I didn't really want to take on that large financial burden. And it ended up working out too, because, the kids got to stay in the house part of the time as well. And I was able to move out. I moved into a couple rental places in the interim and then bought a new house in a close by neighborhood, lower tax area. And it's been a good decision, I think, for everybody.
I'm going to go back to Gary because there's a question here, Gary, that it says, how does infidelity on spouses part benefit one in the divorce? Some actual expenses used for it were found, but no cash was used a lot to cover it. Okay, so let's just talk about what this is. So I'm going to just kind of like give a brief background for a second. In New York, as I think in many states, unfortunately, nobody gets dinged for infidelity. Okay, so let's start there. It's just, it may actually affect custody in some ways, but it's not going to affect how the finances are divided. However, there is something called wasteful dissipation of assets. Okay, and wasteful dissipation of assets is where your spouse has used assets that were marital assets for perhaps infidelity, hotels, vacations, fancy gifts, all of those things, restaurants, all of that kind of stuff, and or, okay, used it for substance abuse, alcohol abuse, all of that, okay?
Gambling.
And gambling, exactly. Okay, so we've kind of covered the gamut about what wasteful dissipation is. So Gary, how do you come into play in terms of wasteful dissipation? What do people need to show you, and what do you do?
Well, one of the things that you do is you first things you do is you sit down and you interview, because that individual has the knowledge as to what's going on. Then what you want to do is you want to look at things like the bank statements. You want to compare it to the money that's coming in versus the money that's going out. And you want to also, again, this ties back to the income stream analysis and lifestyle analysis, because there's a lot of things that are there other than this dissipation. But you want to look and see what other assets are going out and where they're going. And then, this, believe it or not, leads to another area that we didn't even touch upon yet, which is called hidden assets. And those are assets that are taken out, dissipated from the marital estate for the benefit of one spouse, and that spouse only. And that happens, oftentimes.
So let me just say one thing. It's you have to quantify, meaning you got to put a number, okay? A real number on what has been dissipated. So it's not enough to go to the judge and say, my husband went out with his girlfriend and he spent all this money on vacations and he spent all this money on restaurants, and he bought her all these beautiful clothes, and she's got these Bottega bags and blah, blah, blah. Okay. Judge doesn't really have anything to do with that. Okay. What the judge needs is a number. Okay. With
Correct.
documentation to back up the number. No number, then it's just a sad story and you're not getting any money back. And if
And
there isn't, go
And
ahead,
I'm
Gary.
sorry, I was going to say, and oftentimes these areas that get dissipated are things like in cash because they're for gambling, they're for drugs, they're paramours sometimes, they're for other things that people do not want to have a trail of. Therefore, they might take out, just lump sums and, not report, or record where they're going.
So someone earlier, first of all, I want to go back to one thing Nikki was talking about, which was the home, the marital home, because it's become such an issue. And Nikki, I don't know if you're seeing this, but what are you seeing happening because of interest rates being on the rise? Because that has changed. I know in my office, that has changed the dynamic of whether people sometimes keep the family home or not. So can you
Yeah.
talk to us about that?
Sure. To Robin's earlier point, a lot of clients that I work with who are in the transition process, either finalizing their divorce or in the first year following, they're renting. And especially thinking about big picture of where do I want to live? How close do I want to be to my kids? Is my former spouse going to move and I'm going to have to move again? Or do I get more say over where they get to go? And again, operating within the scope of my practice, a lot of those decisions get made in conversations with Lisa and with the judge so that you're all on the same page, which brings us to a point of discussing who to talk to and when to talk to those folks. Because sometimes you want to call your financial planner. Sometimes you want to call your attorney. Sometimes the person you need to talk to is the forensic accountant. And sometimes who you need to talk to is your divorce coach.
So again, I'm going to remind everybody that when you decide to pick up the phone to talk to your coach, or when you decide to pick up the phone and call Gary directly, okay, or when you decide to pick up the phone and call your therapist directly to speak about these things, they're not necessarily privileged. Okay. The only privilege that you have is with your attorney, which is why you really need to find a good attorney that's going to have your back, who can communicate with all these people. You have to be super careful about privilege because you don't want your spouse to know what your strategy is, and your emails and your text messages and all those things to all those other professionals, they're all discoverable. So be
And
careful.
and be careful what you share with other professionals too, because
Yes,
you don't want to talk to me about something that's not financial related. You don't want to talk to your therapist about financial related, etc. You
exactly.
really got to compartmentalize and bucket your conversations.
And I'm going to go back to this interest rate issue, and your renting, Robin. So we are finding more and more that people are not necessarily taking on the family home because if they have to, usually if they are taking taking on the family home, they are going to have to refinance the home to take the other person off the
Yeah.
mortgage, which means that they are likely going to be stuck with these high interest rates right now. So talk to us a little bit about why you think the renting actually worked for you for a while.
Yep. So for me personally, it was a really great transition decision. Just as Nikki said, there's so many moving pieces. When you really try to distill down divorce high level, it's about kids and it's about money. But then there is the next level, which is housing, schooling, work, childcare, cars, all these other things. And there's no possible way to tackle all of those at exactly the same time. So you have to kind of pick something and lock it down, or at least lock something down at first, and then put a few more pieces together and see how it's working for you. Is it good? Is it bad? Do you want to tweak it a little bit more? And so having the house, which is a big decision, as something that was, fluid and flexible, was really, really helpful and important to me because it allowed me then to get more of those other pieces centered. And about a year and a half after I started renting It was actually my second rental house because of COVID, but that's a whole other story. And my lease was going to come up in about 6 months. And I had this idea. I said, this is a great house. I could stay here. It's good. But if I could find something nicer in a better location, less expensive, and that I can own, that would be like a win-win-win-win. I should do that all day long. And I didn't know if it was possible, but I spoke to my realtor and she found me something. So I think that's my other big takeaway that feeds into a lot of the themes that we're hearing tonight is you're not going to know the answers to all of these different things. You're not going to know what ex parte is. You're not going to know how to do an income analysis. You're not going to know should you rent or buy your house. Like most people, no matter how smart you are or what job you have, or you're just not going to be able to know all these things. So you need to work with good people and you need to trust the experts. And this pertains to, all of the stuff that we're talking about tonight with finances. It pertains to stuff with, therapeutics and children and, education and things like that. So really work with good people and trust the experts.
I think that's really good advice. So I'm going to go back to some of these questions that are in the chat. So somebody has asked Gary about how does commercial property get assessed for selling it, land, building, airspace, and an ongoing business. So break that down. First of all, what experts do you need? Because now we're talking about real property also.
Right. So for real property, you really need a real estate appraiser. And oftentimes businesses that own their own buildings will hold the real estate in a separate LLC. The reason is you typically hold assets such as real estate in an LLC because there's a depreciation pass through. And depreciation, just to give you an example, you buy a building for $1 million, you depreciate it over its estimated economic life. So you take 1/15th or 1/30th of that building every year as an expense. But that depreciation will shelter the rent that the business is paying. So over here you have the business operating, paying rent to a building over here, sheltering the cash flow of the rental payment. So they get a deduction over here. The income is sheltered by depreciation. So most businesses hold these two types of entities separately. So you would need a business valuation of the operating company under one of the three methods I discussed before. And you would need a real estate appraisal when you do the building. Now, the interesting thing is 9 times out of 10, when we have these real estate appraisals done, the operating company is typically paying below market rents to the real estate company. Why? Because going from one pocket to the other. So when we go in, we normalize it both on the operating company side and the business side. I'm sorry, the building side. And what that does is it drives up the value of the building, might deflate the value of the business a little bit, but in the end, it's a wash. However, sometimes the building and the operating company is not held in the same percentages. Sometimes you might have a father and children, or a mother and children holding the operating company, or you might have other people owning the building itself. So you really, it's not a straightforward transaction. It gets a little more complicated, but it's certainly worth the cost of unwinding it because that's where a lot of the value is hidden.
So Robin, I think it was you who brought up it's tax time. I just want to remind everyone, so it is tax time. And if you're going through a divorce, you may want to speak to your attorney about what's called an indemnification agreement. Okay. It's really important. And please don't wait to the last minute. I can't tell you how many people call us like on April 14th and 15th for these indemnification agreements. The reason you want one is you want one for a few reasons. You may file joint tax returns because it may be less expensive if you're filing jointly. But if you have, okay, the interest in filing a joint tax return, you may not want to actually acknowledge that the other spouse's income is, remember when Gary spoke about that $50,000 when we're spending like, you know, 150,000 a year, okay? So you
1.5
may
million.
want to, right, you may want to protect yourself, and the indemnification agreement will allow you to actually file jointly and save the money, but also it essentially should say that just because you're signing the tax return does not mean that you're admitting that the income on the tax return is correct that your spouse is putting on. Okay, it's really important. It does other things too, but it's important, and it's going to be tax time before you know it, and don't wait to the last minute. So I'm just going to say that, okay? Because as I said, the office gets really busy for indemnification agreements at the very last second. Also, don't sign the tax returns without speaking to your lawyer first.
Mhm.
So that, because then you won't likely have the indemnification agreement, and then you'll say, why didn't somebody tell me this? Because you didn't speak to the lawyer first. So always good not to make the move before you've spoken to the lawyer who is working with you.
Can I add something in there really quickly, Lisa?
Yes,
I think a
please.
lot of times people that are going through a divorce are trying to save money and they don't want to call their lawyer or email or text their lawyer all the time unnecessarily, which is a good strategy. However, your lawyer is not a mind reader and they do not walk around in your shoes all day long. So they don't know the things that are going on, both financially and non-financially. So what's really important is when you start the process that you ask your lawyer, what are the kinds of things that you need to know about right away? What are the kinds of things that you need to know about like once a week? I can, put together an email and send it to you. What are the things that are not going to be of any importance to you whatsoever, so I don't need to bother you? And you're going to need to fine tune that list as you move through your process. And you should be having the same conversation with each one of the professionals, with your forensic, with your accountant, with your whatever, because you just don't know these things. You can't know what you don't know. But if you don't ask the question, you're just spinning wheels unnecessarily and running up your bills.
I think that's right. And I think that people, it goes to the other part. How long does the process take? So
As long as
Robin,
it takes.
I'm going to have you answer it, and I'm going to
Yeah.
have Gary answer it, and Nikki too, if you can jump in. I mean, I'm going to say this is a marathon, not a sprint. So I'm going to say that
That's,
first and foremost.
Yeah.
I
So
agree.
Robin, what's your
Yeah,
feeling?
yeah, it takes as long as it takes. I like to say that when you go through a divorce, it's kind of like doing a renovation where you're tearing down the walls of your house. You just don't know what you're going to find there, but you're going to find something that's going to cost you more money and take longer than you thought you would. So be prepared for that. Everybody wants to get it done, and it doesn't work that way. It just doesn't. So there's the financial element to that, understanding how you can pay your lifestyle in this interim and pay your legal bills and whatnot. But it's also the emotional and the mental, perseverance to get through what feels like a never ending process, but they all do end. So that's
In
all.
addition, let me add to this.
Yeah.
They're not going to voluntarily oftentimes give you all the items that you request. Sometimes it's going to take subpoenas. Sometimes those subpoenas will drag on. There's been a lot of mergers of banks and other financial institutions in the last few years. And oftentimes a bank that was being used 3, 4 years ago was either no longer there or is a new bank today. So oftentimes that data is not readily available. So patience is one of the things that you have to have, as Robin just said, because and I agree with Lisa. It's definitely a marathon, not a sprint. If you sprint
Yeah.
it, you're not gonna you're just gonna get pains in your stomach.
Yeah. My heart goes out to everyone who's getting divorced, because I'll tell you, when I was 9 years old and in a wheelchair and my mom was also getting divorced, it was such a heartache for her going through this whole process. And for her, it took about 22 months. But I'll say, especially as you're going through, consistency is more important than anything. And having folks on your side to ensure accuracy is going to be your best bet. how I finished my Ironman in 2023, staying consistent all the way through. So,
The other thing is too, you might not get another bite at the apple. And Lisa could tell you that better than anybody because when it's done, it's done.
It's 100% correct. This might be your biggest bite at any apple. So you have to really realize that. You know, I always say to clients, and maybe Robin has heard me say this, but um, if you look at how much you might make in the 2 years, okay, you might never make that income again. Okay, so yeah, it may take a year. Frankly, it may take two, okay, because the court systems are slow. Okay, but if you think about the amount of money that you may make in those 2 years, as opposed to what you could earn in those 2 years, it could well be worth the 2 years, and you have to look at it that way. So that's what I would say. I'm going to go through some of these questions really fast. Somebody, I think this was about the infidelity, that only 3 months of checking statements were asked for. If that's related to the infidelity, that seems very insufficient. Usually if I find that there's infidelity, I go back my full 7 years that I can get the subpoenaed statements. I have a theory about infidelity. It's basically like if it happened once, it probably happened more than once. It's a pattern usually. It's not a one and done. And so I'm not saying it's always that way, but I like to go back through the statements. And that's something, by the way, there's a place to save money. You can have your attorney subpoena all the statements and you can go through them. You know which restaurants you went to. Okay, you know which hotels you stayed at. You know if you got a gift from Tiffany's or not. Okay, you can do that job and actually put together the list. All right, so that's a place that you know your life better than anyone else, but your attorney needs to subpoena the statements. 7 years is as far back as you usually can go. I'll say the same thing for separate property. 7 years is about as far as you can go. However, if you push further, sometimes to prove your separate property, you can get your financial advisor, you could get your broker, you could get somebody to give you more statements, okay, to go deeper into the well. All right, you got to push hard, and there may be things on the statements or tax returns that may be available that will help somebody like Gary to actually help trace more separate property. There's a very complicated separate property tracing question here. It has to do with IRAs that were inherited. I'm going to say that this question is a great question. It sounds like there was a lot of what we call commingling, which is mixing of assets. I looked at this question a few times and I thought, this is a complicated question. It really needs to be answered by an attorney and perhaps a forensic accountant. It's going to need statements. You might have stock in these accounts that can be tracked back. There's ways to do that, right, Gary?
Yes.
So that's one way to take a look at it, but you're going to need a lot more information than what's in this question, frankly. You're going to need a lot of documentation.
Also tax returns could be beneficial because you get the deduction for the IRA on the tax returns. And one thing when Lisa was talking about a minute ago, if you go through and you make a list of things, have somebody sit down with you, a friend, a colleague, somebody, and do it in Excel. The reason I like it in Excel rather than handwritten is because it sums up the data. It could be easily run as a pivot table so we can look at various things. Excel is not that complicated. Even I understand it. No, I'm kidding. Yeah, it's a pretty easy program to use once you see it. It really is easy once you start using it for a couple hours. But it will make a world of difference in sorting, summarizing, and even making changes to the data. Paper statements are not going to be beneficial.
If money was inherited during the marriage and then it was used in our joint business, it's possible that it was commingled. Okay, so I'm going to say that. I don't know what the joint business is and how it was held and how the money was used. And it sounds like the money was lost in the joint business possibly. So let me just say something. If the money is spent or lost, you can't recover it as separate property. It's gone. Okay, that's why it's so important to have kept your separate properties separate and to make sure you trace it. I can't get back something that has been spent. Okay,
Correct.
so if you spent it, I'm sorry for that because you cannot get back separate property that has been spent. So you might have some other, maybe you get more of a business asset, maybe in terms of the valuation, when the valuation comes in and there's a percentage being doled out. Maybe if you used your separate property for that business and the business has a value, maybe you get more of a percentage of the appraised amount. So it's not a lost cause, but you need to dig deeper and speak to an attorney. There's another one about the family home again and the mortgage being in both names. Could the mortgage just be put in your name? So the answer is yes, okay, if you can refinance, if you're going to meet the qualifications of the bank. And that's the problem. And by the way, it goes back to the interest rates. If you have a 2% or 3% interest rate on your mortgage, don't expect to pay the same amount now in your mortgage payment every month. When you refi, they likely will not assume, the bank will not likely assume let you assume the old mortgage. And so your interest rates will rise. And you have to figure out, do I have enough to make those payments every month? And then we've talked about the subpoenas. I'm just kind of looking, talked about the IRAs, and I think I've answered all the questions that can be answered. So I think we're up at the hour, even a little bit over. And Judy, do you want to take over?
Yeah, no, I think you answered so many questions. This was fantastic. Anyone who has any further questions, use the free financial helpline. You've seen in the chat how people have already used it in the past, how beneficial it is. And all I can say is, please use these free resources. It will move you forward to the next level and give you resources and other direction, and give you recommendations of people to use. But use your professionals. And I think this has been great advice from each of you. And I want to thank you, Lisa and Gary and Robin and Nikki, for sharing your expertise and your insights, because it is a long haul, but I love the consistency, be persistent. It is, take the time. It is a marathon, and be smart about it and own your money. Start now. Start understanding that lifestyle and where your expenses are. Start gathering those receipts. And when you don't have it, reach out to your resources, your attorney, so you can have those subpoenas put in place. So I want to say thank you to everyone. Make sure to sign up for our next program, which the last one is next week, for our final panel on moving forward in your divorce. So thank you so much.
I'm going to say one thing about that panel. It's got a very interesting speaker. Nick Mendez actually is going to be speaking about forensic computer work. We use Nick a lot in dealing with forensic computer stuff, because people put spyware on your computers. They are reading your messages. What can you do? What you can't do? All of those things, they're really important. And I think that it's really important to know about it. We, as a result of Nick last year, we did actually find that there was spyware on people's computers, and there were some other ways that people got into servers, etc. It's really important. And we've learned about some other tracking systems in the last week or two, which I will be asking Nick about next week. So
no, and she'll be joined, and Nick will be joined by Donna Cates, who's also joining us. And she is a CDFA, so she'll also have some good insights to share with all of you. So thank you, and we'll be sending the recording out to everyone.
thank you all.
Thank you. Have a good night.
Thank you.
Thank you. Thank you. Thanks, Robin, Gary, Nikki.
Bye-bye.